The market didn't make an announcement. It didn't hold a press conference. It left a number behind. Right now, physical silver in Shanghai is trading at a premium of roughly $25 over Western futures. In a normal functioning market, that gap wouldn't survive. Arbitrage would erase it quickly. Traders would buy where silver is cheap, sell where it's expensive, and the spread would collapse. But this gap isn't collapsing, it's persisting, and that tells us the system is under stress. When a price difference like this refuses to close, it stops being a spread and starts being a signal. It tells us physical silver is being valued differently than paper silver, and the bridge between the two is weakening. Here's why that matters. Futures markets are designed to reflect expectations about future supply. When futures in one region trade at a large premium to another, it means the market is pricing in scarcity ahead, not just today. Historically, the Shanghai premium over Western markets averages only a few dollars. A $25 premium is not normal. It's a regime shift. If this were free money, arbitrage desks would be all over it. They aren't a T because arbitrage only works when three things are true. You can source metal in size, move it efficiently, and trust the rules won't change mid-trade. None of those conditions are guaranteed right now. First, sourcing. The price you see on a screen is theoretical. Try buying large quantities of physical silver at that price, and liquidity disappears fast. The market moves against you immediately. Second, logistics. Moving physical metal across borders takes time, insurance, and regulatory approval. Prices can change dramatically while metal is in transit, turning a risk-free trade into a gamble. Third, rule risk. When spreads widen and pressure builds, exchanges don't sit still. Margin requirements change, position limits appear, delivery rules get adjusted, arbitrage becomes dangerous, even unworkable. This is why the gap can persist, and even widen. As higher prices in Shanghai pull metal from Western vaults, inventories shrink. As inventories shrink, delivery risk increases. As delivery risk rises, buyers become more aggressive. That feedback loop reinforces itself, tightening physical supply further. And here's the critical point: smashing the paper price does not create new silver. If Western futures are pushed lower, while Shanghai continues to bid for physical metal, the gap actually grows. That increases pressure on Western inventories and accelerates the drain. Paper suppression can delay repricing, but it cannot solve a physical shortage. So what happens next? There are three paths. The first is repricing. Western markets are forced higher to reflect physical reality. This won't be smooth. It will be volatile, fast, and disorderly. The second is suppression. Margins rise, volatility explodes, and prices whip violently, but physical demand remains intact, keeping pressure on supply. The third is a two-tier market, one price on a screen, another price for actual delivery. That's the most dangerous outcome, because once confidence in price discovery breaks, liquidity follows. What should you watch? Watch whether the Shanghai premium stays elevated. Watch Western inventory levels. Watch dealer premiums and delivery times. And most importantly, watch what happens when paper prices fall. If physical prices don't follow, the fracture is widening. This isn't about hype. It's about structure. When physical metal trades far above paper claims, the message is simple. Price discovery is struggling, and the market is paying to escape promises and secure reality. The only question is whether you're paying attention to them.